Legends of Trading. Richard Wyckoff. Richard Wyckoff was a notable figure in the world of stock markets. Born on November 2, 1873, in the town of Romulus, Michigan, he later moved to Nebraska with his family, where he spent much of his childhood. Wyckoff did not attend college, but instead began working as runner for a brokerage firm in Omaha at the age of 15. In 1893, Wyckoff moved to Chicago, where he worked for several brokerage firms and gained valuable experience trading in the stock market. He also began writing about finance and investing, contributing articles to a number of financial publications. In 1901, Wyckoff moved to New York City, where he founded the Magazine of Wall Street and established himself as a prominent financial journalist. The Magazine of Wall Street became the largest circulation of any financial publication worldwide. He also served as the editor of Stock Market Technique. He continued to trade in the stock market and develop his own trading methodology, which would later become known as the Wyckoff Method. By implementing his methods in the financial markets, Wyckoff was able to accumulate considerable wealth, eventually owning a mansion and 9.5 acres of land in Great Neck, New York, next to Alfred Sloan, the industrialist of General Motors. As his wealth grew, Wyckoff developed a keen interest in educating the public about their experience with Wall Street. He channeled his passion towards teaching and publishing exposés, such as Bucket Shops and How to Avoid Them, which was published in New York's The Saturday Evening Post from 1922 onwards. The article provided an in-depth analysis of bucket shops, which were a type of illegal brokerage firm that operated in the early 20th century. Wyckoff explained that bucket shops were essentially gambling operations disguised as stockbrokers, where customers could place bets on the price movements of stocks without actually owning them. The bucket shop operator would take the other side of the customer's bet and would manipulate the prices to ensure that the customer would lose money. To avoid falling victim to a bucket shop, Wyckoff advised readers to only do business with legitimate brokers who are members of recognized stock exchanges. He also suggested that investors should educate themselves about the markets and should never rely solely on tips or advice from others. Wyckoff warned that dealing with bucket shops was not only financially risky, but also illegal, and encouraged readers to report any suspicious activity to the proper authorities. Overall, Bucket Shops and How to Avoid Them was a cautionary tale that served as a reminder to investors to be vigilant and to only do business with reputable and trustworthy brokers. Wyckoff remained an active trader and educator in the stock, commodity, and bond markets during the early 1900s, and he developed a deep curiosity about the underlying logic behind market movements. He conducted interviews, held conversations, and researched successful investors and traders of his time to enhance and document the trading methodology he used. These included Jesse Livermore, Otto Kahn, and J.P. Morgan. It is said that Wyckoff had lunch with Charles Dow every Wednesday and that he was interested in the Dow theory and its applications. Wyckoff's trading method is based on the idea that the market is controlled by a group of large traders or smart money who leave footprints in the price and volume data that can be used to predict future market movements. The Wyckoff method involves analyzing price and volume data, identifying market trends and patterns, and using that information to make informed trading decisions. The aim is to identify and follow the actions of large traders or institutions in the financial markets. It is based on the principle that prices move in waves, and that these waves are caused by the actions of large traders who buy and sell in significant volumes. It also involves studying the behavior of the market during different phases, such as accumulation and distribution, to identify potential market trends. Wyckoff and early tape readers recognized that price movements do not unfold uniformly over time, but rather in waves of varying magnitudes. Consequently, they examined the correlation between upward and downward waves. Rather than following a linear path between 2 points, price moves in a wave-like pattern that, at first glance, may appear random, but is in fact influenced by fluctuations. By scrutinizing and comparing wave characteristics such as duration, speed, and range, one can ascertain the trend's nature. Wyckoff proposed a method to comprehend price movements in individual stocks and the market as a whole. According to Wyckoff, one should study all the fluctuations in the market and various stocks as if they were the result of one person's operations. This person, known as the composite man, manipulates stocks to the disadvantage of those who do not comprehend the game and to the great profit of those who do. Wyckoff encouraged retail traders to play the market game as the composite man played it, whether the market moves were real or artificial, resulting from actual buying and selling by the public or artificial buying and selling by larger operators. Wyckoff's chart-based approach relies on three fundamental laws that influence various aspects of analysis. These laws are used to determine the market and individual stocks' current and potential directional bias, select the best stocks to trade long or short, identify the readiness of a stock to leave a trading range, and project price targets in a trend from a stock's behavior in a trading range. These laws serve as the foundation of every chart analysis and stock selection. The first law is the law of supply and demand, which determines price direction. Wyckoff's trading method revolves around this principle. Prices rise when demand exceeds supply, and prices fall when supply exceeds demand. The balance between supply and demand can be studied by comparing price and volume bars over time. While this law may seem simple, accurately evaluating supply and demand on bar charts and understanding the implications of supply and demand patterns takes extensive practice. The second law of Wyckoff's chart-based methodology is the law of cause and effect, which helps traders and investors set price objectives by gauging the potential extent of a trend emerging from a trading range. According to this law, the imbalances between supply and demand are not arbitrary, but rather emerge from certain events after a period of preparation. This law highlights that an uptrend or effect is the outcome of a previous period of accumulation or cause. Similarly, the effect of a downtrend is caused by a previous period of distribution. The third law is the law of effort versus result, which provides an early warning of a potential change in trend. Divergences between volume and price often signal a change in the direction of a price trend. For example, several high-volume but narrow-range price bars after a significant rally, with the price failing to make a new high, suggest that large interests are unloading shares in anticipation of a change in trend. Richard Wyckoff's wife was Margaret. She was his lifelong partner and they had 3 children together. Margaret was also actively involved in Wyckoff's work and helped him in the publication of his books and courses on trading and investing. Richard Wyckoff passed away on March 19, 1934, at the age of 60 in Sacramento, California. He died of a heart attack while on a business trip to the West Coast. After his death, his body was transported to Brooklyn, New York, where he was buried. In the latter years of his life, he continued to teach and write about stock market analysis and trading. He founded a teaching company in Phoenix, Arizona in 1931, where he taught his courses until his death. His courses continued to be taught at the Institute after his death, and his teachings have had a lasting influence on technical analysis and trading. The company changed hands several times over the years and became known as Wyckoff Stock Market Institute. Thanks for watching this video. We hope you've enjoyed it, and if you feel we've earned it, consider subscribing to our channel. Should you wish to learn more about the Wyckoff Method, you can take our advanced swing trading course. You can click on this link or you can find it in the video description below. We'll be back soon with another video.